Right, next we've got Zanile from 361 Asset Management. Zanile, if you can come to the front, thank you so much.
Good morning, everyone. Just checking if you're all still awake. The last speaker slot before, on SA Equity. My name is Zandi. I'm from 361 Asset Management. So one thing I like to do whenever I come to do a presentation is kind of eavesdrop, outside when everyone's having coffee, because I love to hear the different pronunciations of our name. So sometimes it's 361. My personal favorite is 360 ne, but it is actually 361. It's just to get that out of the way. So who are we? I think most of you are quite familiar with our firm, but for those who aren't or might want a bit of a refresher, we've been around for about 20 years now. We're owner-managed. Our team has had very limited turnover over that period, so you've had the same people who produced our track record still managing money today. We're style agnostic, and what that means is we don't like to label ourselves as value managers or growth guys. We think that markets go through different cycles, some shorter than others, and you need to be prepared as a manager to be flexible and change, adjust according to different market conditions. So hedge fund thinking, we started out as hedge fund managers. And what we think hedge fund thinking means is, challenging conventional wisdom and focusing on risk management. Now, despite being around for 20 years, we are still quite a small boutique. Our AUM is around 60 billion rand. So that means we're still really flexible, we're nimble in the market, and we can own some of these smaller companies that we've been talking about this morning. And lastly, we offer quite a diverse range of products. Hedge funds, like I mentioned, unit trusts, multi-asset, because we think that each of these products has its place in a client's portfolio, and so we'll never advocate for one over the other. But when it comes to SA Equity, when people ask us what we think sets us apart, what is our differentiation as 361, we think that really is the ability to deliver consistent outperformance on a risk-adjusted basis. So those are a lot of, words, but what it really means are the graph that you're seeing on the slide right now. So what that shows is the result of an Alexander Forbes Manager Watch survey, which took 44 benchmark cognizant managers and measured them according to the classic finance relationship, risk and return. And in that survey at the end of June this year, we're quite humbled to see that we came out first in that survey. And what that means is that we're able to deliver exceptional returns for our clients with less risk in our SA Equity Fund. So how do we do that? Well, that's the outcome. And it really is the result of two main ingredients of our process. Firstly, we are active managers. We're very active. And as you can see there, if you look at our key portfolio metrics, we've managed to consistently outperform the benchmark. So if you look over a 5-year period, in 60 months, we outperformed in 73% of those months. It's not a bad grade. I haven't had to have grades in a while, but I think that's pretty decent. And people normally think that means that you're also quite, aggressive, risk-taking hedge fund managers. But the truth is, the second ingredient that we think is really important in our process is capital preservation and a focus on always protecting our clients' capital. And the example we've given here is in 2020. When the market was pretty much flat, our funds were still able to outperform. And that's that risk management hedge fund approach, always protecting capital on the downside, but being very active managers. And it's a result that we've been able to have across those different mandates. So whether it's SA Equity, our flexible fund, or the PPS Managed Fund, which we do manage on behalf of PPS, you can see that over these different time periods, our performance, the red bars, has been above the respective benchmark, the blue bar, resulting in that consistent outperformance over time, represented by the gray. So now let's talk markets. Looking back, it hasn't been a boring year at all. In fact, we all know bull markets, bear markets. 2025 has been what we call a bit of a kangaroo market. So, instead of very explicit rising prices or falling prices, we've had a great level of unpredictability, volatility. There's a lot of geopolitical pressure that has happened in the market, and a lot of instability, having us question the dollar as a reserve asset, having us question safe havens, the US Treasury market. Is that still the best way to protect your capital? And all of these questions have led to this very concentrated outperformance in the JSE because of our exposure to precious metals. So a lot of the previous speakers have already spoken about this, and Chris Reddy, Mr. Reddy, very important, remember his surname, from All Weather, presented the same information. That if you look at the top 10 share, if you look at the JSE up to the beginning of August, 10 shares drove 94% of the Aussie's returns. It's quite a staggering statistic. But it does show something that we think is really important. That whether it's a bull market, bear market, or a kangaroo market, there are always places where you can find value. So we've responded to this kind of environment by really playing to our strengths. So firstly, I mentioned that we like to be active managers and we like to stay nimble. So the example I've shown with that is a specific share, Anheuser. So if you look at Anheuser's share price year to date, which is the red line, you can see that in the beginning of the year, the share performed really well, had a very strong result. And now we're sitting at it probably being up about 9% year to date. Doesn't sound like a very sexy return. It's not one of those top 10 shares, but it's actually been one of our biggest contributors when it comes to our outperformance. And that's because when the facts change, we change our mind. So what those gray bars are showing are our holding of Anheuser, our relative overweight. So coming into the year, everyone held SA Inc., Rand hedges were just, completely dismissed. And we increased our overweight during that time when the valuation was very attractive. Then you started to see the share price running up quite a bit into their results, and we made sure that we lowered our position because the valuation didn't look as attractive anymore. So that kind of speaks to our process. It's not just about looking at a share's value and seeing that you have to buy and hold. In a kangaroo market, you have to make sure that you're nimble, you're flexible, and you're responding to changing information. So that approach has really been a key factor to our performance this year. And secondly, part of protecting capital is avoiding what we call landmines. As hedge fund managers, we do quite deep, thorough research on companies where we don't think there's a lot of value. And we were quite fortunate this year to have missed some of those landmines in the market. We've shown a company like Aspen here, which isn't a terrible business. It's not a zero. There definitely is value there, but the market's expectations just didn't match the true value of the company. And lastly, strong stock picking. We have a team of dedicated analysts that look at each of the different sectors. And this year, we've had some pretty good picks that have played on some of the themes we've been chatting about this morning. The Chinese market doing really well. Naspers and Prosus have been a huge overweight for us. And we were given a gift in January when there was some volatility and you could just pick up those shares at a really attractive valuation. Our gold pick has been Anglo Gold Ashanti. We've just preferred the higher quality play in that sector. And then a couple of other names that have worked out pretty well for us. Okay, that's what we've done. Sitting in September, spring, new beginnings. What about the rest of the year? How are we actually going to make money and make sure we can keep up that, nice performance that I showed you earlier? Like I said, we think that despite market conditions, there's always something interesting happening. So there are a couple of themes that we've been watching. Now, precious is the big elephant in the room. We cannot talk about the SA market anymore without talking about precious metals. In the previous presentation from Investec, we saw that PGMs and gold now account for about 21% of the index. So as active managers, we have to take a view. What we've seen with gold is the Chinese central bank has, toned down their buying a bit as the price has risen. But the reality is you still have so many macro themes that are supporting that demand for gold as a safe haven asset. So right now, we do have a slight underweight in our funds. We think that a lot of the easy money has been made, and we're still, reflecting our gold. I guess we do still like gold, but we're holding on to the Anglo Gold Ashanti. And on the other side of the curve, we've also picked up some Harmony after the recent sell-off, where the share just became way too cheap. Even though it's not a good quality business, we think that in the short term, you can probably still realize some value because the market really overreacted to the last results. PGMs, I think everyone has already spoken about their view here. We like the sector. The recent placing of Valterra gave us a really great entry point into the sector. So that's one of our significant holdings now when it comes to PGMs. And we also like Northam, which is the other quality play in the sector. Now, another theme that was touched on in the Visio presentation is rest of Africa. I think if we had to go over, the last 10 years or so, whenever an SA company was expanding across the continent, we kind of gritted our teeth, closed our eyes, and just pushed the sell button. Because SA companies have not done well outside of our borders. The tide is turning. This weaker US dollar has really supported a lot of these countries. It's helped them clean up their fiscal positions, but we've also seen a lot of reforms coming through. With Nigeria, you've got a regulator actually allowing price increases. So now you've seen this rest of Africa exposure no longer being a detractor from performance, but actually contributing to earnings growth. So it's been an MTN story, but even outside of that, if we look at our banks, Standard Bank has a significant presence across the continent, and our research has shown that SA banks are taking share in a lot of these countries. They're competing against some huge global banks and some local banks and are actually doing really well. So there's Standard Bank, but there's also ABSA, which people don't really think about with the rest of Africa. But after the Barclays deal, they have a really great footprint, and now a CEO who's coming from Standard Bank has seen the playbook and knows how to take advantage of that presence. When we were thinking about what to present today, we kind of assumed that it would be the typical, negative sentiment about SA. And so as a team, we wanted to make sure we also highlight the good stuff that's happening. Now, as managers, we understand that everyone was probably too euphoric last year, post-GNU. We kind of put the cart before the horse in thinking that everything would now be amazing and all these reforms would come through. The lesson learned is that these things take time. And we are seeing really positive progress, and we wanted to mention Transnet. The reform agenda has now moved on to rail. We know that the government doesn't have the resources to invest in the required infrastructure, so the private sector needs to participate. And so we have exposure to Grindrod, which will be a major beneficiary of the turnaround at Transnet. And secondly, if you look at SA, we are an emerging market. So a lot of the time, you don't need us to, shoot the lights out, have a maverick president like in Argentina who's completely going to change things. You just need stability. And this year, we're being helped in the stability department. With precious doing well, with lower oil prices, a stronger currency, our terms of trade are looking okay. So the fiscal picture isn't that bad. And all of this supports a stable environment. And of course, SA Inc. is still cheap. Our bonds have done really well, our currency has done well, and when we speak to different emerging market managers, that's what they're attracted to in SA. They haven't had time to look at our equities yet. But we think right now you're in this really great position where you have good businesses, especially in the banking sector. The example I'll use is ABSA. It's trading at a 6.5 times PE with an 8.5% dividend yield. And there are a lot of positive catalysts if you're looking 12 months out. I mentioned the new CEO. And what that means is you're getting paid a dividend. So you're literally getting paid to wait while the company sorts out all of its issues. So even if, the new CEO doesn't live up to these expectations that I've outlined today, that's still a very decent entry point, and you'll still get some return on your investment at these prices. And those are the kind of SA names that we're liking right now. And looking at our broader positioning, I mentioned Absa already. I don't know if it was clear yet, but one of our top overweight positions. We think that the bank is going through a bit of a turnaround, but once again, you have that high dividend yield that's making sure you're paid to wait. We like Glencore, ARM, Naspers Process, companies that have already been mentioned this morning, and we still really like Grindrod. We think it's well positioned. When it comes to our underweights, I always say to clients, don't read too much into that. It doesn't mean that we think those are terrible businesses. In fact, those are some of the best businesses on the JSE. We just don't think the valuations are attractive right now. And we see better opportunities for better returns in the market. So that's who we are as 361. That's what we like right now. We think that there are still opportunities in the rest of the year to make money locally. And just like everyone else said this morning, SA is cheap. And they are really good companies. And most importantly, in a lot of these, we're currently being paid to wait. So thank you very much for your time.
Zandile, thank you so much.
Thanks,
Very quick question from my side. Very few have actually spoken about that, but you've touched on it briefly. The dollar weakening at the moment, the rand gained. How does that impact on rand hedge stocks in a portfolio, and how does that come into your thinking?
So this is the beauty of our process. We're fundamental investors, but we also apply a macro overlay. So one would think, in a year where the dollar's been weakening, you would want absolutely zero rand hedge. But as you saw in another slide, 3 rand hedges have been major contributors. So Anheuser, British American Tobacco, and Naspers Process. And that just speaks to the underlying fundamentals of those businesses, getting in at the right entry point. They weren't macro calls. Instead, it was specific companies that were doing quite well. And then the big way that I think that those currency dynamics you mentioned do impact positioning is with resources, where you wouldn't want to be underweight in that kind of environment.
We've seen the active management in your portfolios for many, many years now, so thank you very much. Just want to check, any questions from the audience?
Hi.
Right. Yes?
Actually, 2 questions. Thanks. As an active, how has your philosophy changed over the last 10 years? That's the first question. The second question is, how quickly are you able, let's say you get it wrong, how quickly are you able to change, especially with our volatile political, economical environment?
Great. So with the first one, how philosophy has changed, the market has become a lot more concentrated and smaller too. And so I'd say probably 10 years ago, we weren't benchmark cognizant. As a team, we thought if we liked a stock, you buy 5% and you're good to go. That's how we managed our portfolios. But that doesn't work anymore. We mentioned that with precious metals now being 21%, you might think, if I really like gold and PGMs, I'll make it 10% of my fund. But you have to realize that that means you're actually underweight relative to your benchmark. And so the right holding to have is 30%. If you really want to express that you like it a lot more and you think it'll outperform the general market. So that's something that's changed for us from a process perspective. We became a lot more benchmark cognizant, and that's contributed to more consistent outperformance over time. And then secondly, getting in and out of stocks. So this is an example we really like because we don't always get it right. And when it came to transaction capital, we were on the wrong side of that. So we held the shares into that trading statement that was quite negative. And I think that's where after I joined 361, it was the first landmine that I saw in our fund where we had something go wrong. And it was really incredible to see our senior PMs be very decisive, tell our trader immediately we're getting out, and it probably took us less than half a day to completely exit that position completely. And we even know some of the managers that we did sell the shares to, but that's not important. But what we'll also do in different market environments like now, where you are in a kangaroo market, is we won't hold as many smally liquid shares. So we also manage that risk in that regard. So on a single stock, we can get out, but you also, preempt it. At a time like this where there's lots of volatility, you'll have fewer small caps than you would, let's say, last year, where you've got GN euphoria and, all of SA is just going up.
Always interesting when you exit a position, somebody has to buy it. So I always wonder who's buying it. Is it the red guys, the blue guys? I don't know.
A couple of blue guys.